This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Think back to that question we did after lunch. Again, you don't need to turn back, just look at the screen. We worked out a weighted average. This company, just arithmetic. We worked out the cost of equity, cost of reference, cost of debt. We did the weighting. It was purely an arithmetic exercise. And we said, currently, the cost of borrowing overall, the overall cost of capital is 11%. Okay? Everybody. However, the reason we're interested in the cost of capital, sometimes for the exam it's just for arithmetic. Part A, what's the cost of capital? There it is, finished, you know? But the real reason we're interested, and very often in the exam, is because this company is perhaps going to raise another 5 million and invest in a new project. Okay? And last time we did investment appraisal, and if I said, is this new project worthwhile? You'd set up your cash flows. It's costing 5 million. Set up the receipts and so on. But we need to discount at the cost of money. You with me? And our problem would be, we need to know the cost of that 5 million to be able to discount the project. You're all understanding me here? Well, if I'm going to raise another 5 million, there are two problems, in fact. One problem we've just been discussing is, depending on how I raise the 5 million, the cost might be different. You know, if it's particularly Annie Miller without tax, then think about it. If the cost is 11% now, if it's M&M without tax, however you raise the money, the cost will be 11% after. And I think sensibly, if it's 11% now, if it's going to be 11% after, the cost of the extra money must be 11%. Yeah? However, in real life, and in particularly Annie Miller with tax, there is a problem, clearly, that it may be 11% now, but depending whether the 5 million comes from debt or whether the 5 million from equity, if the weighted average is going to change, well, our problem is it's the cost of the extra money that we need. Yeah. So anyway, we've been discussing it. One problem is that depending how you raise the money, the weighted average might change. Clear? But the other problem, and I will write this down, the other problem is this. That we're going to raise 5 million. If we're going to invest it in a new project, all right? Well, the other thing that can affect things is the riskiness of the new project. What I'm getting at, even if this company was all equity financed, forget debt, if it was all equity financed, and you were to raise more equity, well, if it's 12% now, raise more equity, 12% extra, yeah? But the other problem is that the reason investors want 12% is because of the riskiness. We've said that enough times. But the riskiness of that business depends not only on how finance is raised, but also on the type of business. Some businesses are more risky than other businesses. A firm of accountants, perhaps their profits don't change very much. Because when things are doing well, they've got money from audits. When things are doing badly, they've got money from companies going bankrupt, So perhaps a firm of accountants, their profits don't fluctuate much, I'm suggesting. But on the other hand, if you invested in, an oil company or something, maybe their profits fluctuate a lot more. Now, forget oil accountants, but do you understand me that depending on the type of business, some types of businesses, the profits are fairly constant, if you're with me. Other types, they're much more risky. It might be a lot better, it might be a lot worse. And the other problem we've got is this. If this company is currently a firm of accountants, let's say, and not very risky, if they're going to invest in a new project which involves drilling for oil, well, if the project is a lot riskier, shells are going to want a higher return. If the project's a lot less risky, surely they'll accept a lower return. Do you see the point I'm getting at? That we've got two problems. That the cost of the money, the discount rate, it'll depend partly on how they're raising money, okay, which is what we've been discussing. I think I've said enough. And partly it'll depend on how risky the new project is. If you're investing in a risky project, you'll want a higher return. A less risky project, you'd want a lower return. Does that make sense? The discount rate for a project will depend on two things. It's very short here. I'm sorry, there is a chapter on this, but I'm not prepared to read it to you. It's the previous chapter, but anyway. The discount rate for a new project will depend on two things. It'll depend on the way the money is raised, whether Modigliani Mill is true or whether it isn't true. Depending whether you raise debt or equity, it might be cheaper, it might be more. You with me? It'll also depend on the riskiness of the project. Again, I know it's annoying if I keep repeating, so you must shout if I'm not being clear. But the more risky the project, the higher return we'll need. The less risky, the lower return. But it's a combination of the two factors. Now, what we've just been talking about is the first. And I said there's no numbers involved there, it's just discussion. But it's Modigliani and Miller who have all the theory. And as I've said, that side of it will only be discussion. It's at P4 where we can actually put numbers to it and say, oh, if they raise the money this way, the cost will be this much. Okay? The other side of it, though, the riskiness of the project, is where another theory appears. Obviously, I've got to go through it, and I will. But to decide the return we need to know how risky the project is. Well, there is theory that will tell us, for this risk, what return we need and things. It's something called capital asset pricing model. Now, obviously be patient with me, I will come to the theory. But it's those two factors together that will determine what discount rate we'll use. Okay? Now, as I say, we've discussed the first one, and I've said what we need say. The way the money is raised will affect things. I'm not interested in numbers. The second one, you can be asked to put numbers to, and I'll explain shortly what capital asset pricing model is and the numbers you need. And then I'll talk about how we might deal with the two together. All right? Before I do, though, just one last thing. That example we did, I'm not going to wind back again, but we found the current weighted average cost of capital was, I've forgotten the figure, 11.9% or something. Let's say 12%. All right? I've said, although it may be 12% now, but depending on how you raise the money, and depending on where you invest it, the return we need, I hope clearly, could be completely different. Can anyone tell me under what circumstances would the weighted average cost of capital stay constant? Our weighted average cost of capital there, I think, was about 12%. I don't care whether I'm remembering right or not. But if I told you we're going to raise another 5 million, we are going to invest in this project, under what circumstances would the weighted average stay the same as it is now? To be certain it will stay constant, how would you need to raise your money? In the same ratio as current. I don't care who says what in what theory, but if at the moment your money is borrowed 80%, 20%, well, if you borrowed the new money in the same ratio, surely for that bit of it, there's no reason cost of equity, cost of debt would change. The weighted average would stay constant. Would you agree? For the weighted average to stay constant, you'd need to raise money in the same ratio as currently. Yes? Inessa? All right, I said the other problem, though, if you're going to raise 5 million and invest in a new project, the new project might be more risky or less risky. Well, for that side of it, please, if the weighted average to stay constant, how risky would the new project have to be? If it's more risky, shareholders will want more, weighted average will be higher. If it's less risky than the companies at the moment, if it's less risky, shareholders will be happy with less, the weighted average will be lower. What would be necessary for the new project? What would be necessary for the weighted average cost of capital to stay the same as it is at the moment?
Same risk.
The same risk. Yeah, for the weighted average to stay constant, you'd have to raise money in the same ratio as currently. You are all clear what I mean? You'd need to invest it in a project with the same risk as currently for the company. I want to write one last line and then we can go back. Well, not quite, I'm afraid, but we can start to go back to numbers. But think about that. If the company is currently an oil company with whatever level of risk and therefore shareholders want this return, if the oil company invests in a new project which is oil, then surely the riskiness isn't changing at all. And there's no reason why shareholders' required return would change. Okay? But if it's more risky, shareholders want more, it would affect weighted average. Again, if it's less risky, presumably they want less. Okay? Well, the last line is this. if those two things held true, imagine if I tell you the weighted average cost of capital is currently 12%. If it were the case that we were going to raise more money in the same ratio, and we were going to invest in a project with the same risk, if the weighted average is currently 12, would you agree it would stay at 12? Vita? Inessa? And tell me finally, therefore, if the weighted average is 12 at the moment, if it was going to stay at 12, how much effectively would be the cost of the extra money? 12. The last line I'm going to write on this, listen carefully, I will write it afterwards. If and only if we raise money in the same ratio and the riskiness of the project is the same, if and only if those two things apply, the weighted average would stay constant and we'd discount the project at the current weighted average cost of capital. Would that make sense? If either of those two things change, the weighted average tends to change and we've got a problem. But if and only if those two things apply, then you discount your project at the weighted average cost of capital. Okay? Now, whether you write it or not is up to you. In fact, perhaps you don't need to, because of my typing, if I can find it. It is, in fact, I'm not going to read the whole chapter because I've said it, but if you turn to page 100, page 100, paragraph 3 says when to use the weighted average cost of capital for investment appraisal. It is only valid to use the weighted average cost of capital to appraise a project if, first of all, the level of gearing stays unchanged. We agree? And if the new investment has the same risk as the existing activities of the company. Okay? For heaven's sake, learn that. I mean, you can read the rest of the chapter, it's only saying what I've said, but put a big mark against it. Because very often in the exam, he asks you to calculate a weighted average cost of capital. In these sorts of questions, usually a very short one, a very quick one. But he asks you to do a weighted average cost of capital. He gives you information about a project, that we did last time, setting up the cash flows, you remember? And he asks you to discount it at the weighted average cost. So numbers-wise, easy. We know how to get weighted average cost. We know from last time how to get our cash flows. And we know from last time how to discount. All right. Numbers, we've done it all. But not always, but quite often. He asks you, under what circumstances is that valid? It is only valid to appraise at weighted average on the assumption that we're raising money in the same way and the project's got the same risk. Okay? I do hope that's clear. I really do. You're not going to shout now, but please, if you're the slightest doubt, read the thing carefully at home, slowly. Ask me. Because once you've got it straight, it's not hard, it's easy, you know? Of course, it does beg the question, what if the gearing's different? What if the level of risk is different? Well, if the gearing's different, All he can do on that is ask you to talk. Okay? It's Modigliani and Miller. We've had the talk. I'm not going to repeat it. But the one place he can ask you numbers is a situation where, forget now gearing for the moment, but how can we cope with projects with different levels of risk? Okay? And so, for the rest of the day, can you forget gearing completely? Assume our company is only equity financed, that gearing isn't a problem. Okay? Tomorrow I will actually put the two together. But for the rest of today, then I don't need to keep repeating. Only 40 minutes, 50 minutes, Vita. It's wrong, 55. No, for the rest of the day, can we forget gearing completely? Assume our company's equity financed. What I'm now interested in is how can we measure how risky a project, a company is? And if we do know how risky it is, how can we decide what return we need for that level of risk? You with me? Because you can be asked both. They can ask you, how risky is this company? And if you know how risky it is, they can expect you to calculate the return we need for that level of risk. More risk, you want more return. Less risk, less return. Okay? I feel awfully guilty, but it does mean a tiny bit more talk before I can show you the formulae. The formulae are so easy it's untrue. At least we'll finish on a smile, Vita, even though it means listening to me first. All right, forget gearing. If we say a company's risky, why is it risky? It's because the profits aren't certain. You know, if you were certain what the profits were going to be in the future, if you were certain what your profits were going to be, you'd be certain what the dividend was going to be. There'd be no risk. You agree? But the more the profits are likely to fluctuate, you know, you may expect profits of 100 a year, but clearly, whatever you expect, they may be higher, they may be lower. The more they're likely to fluctuate, the more risky we say it is. Okay? Well, the little bit of talk I need, and I do apologise, but I can't do without it, is there are actually two things that create risk. Suppose I asked you tomorrow to go into your office and forecast your company's profits for next year. All right? Well, of course, you've no idea what the profits were. What you could do is set up a spreadsheet. Sorry, your profits next year depend on what happens next year, obviously. And there are all sorts of possible, what you might call, scenarios, you know. For example, one thing that might affect your profit next year is the rate of inflation in Latvia next year. True? You've no idea what the rate of inflation is going to be, but I think you'd agree it's probably going to affect your profits. Vita? And what you might do, surely, is perhaps set up a spreadsheet and say, well, if inflation next year is 5%, this is what I think the figures will be. If the inflation next year is 10%, this is what it'll be, and so on. You see my point? But in theory, anyway, you could do a whole range of profits for all the different possibilities. Yep? And the more the profits varied, the possible profits, the more risky it is. But there are all sorts of things that are going to affect your profits next year. Inflation, you'd agree, is one thing that's likely to affect your profits. Another thing that's likely to affect them is exchange rates. How much depends on the business. If you're importing and exporting a lot, exchange rates next year are going to have a big effect, you know, and if it's America, the dollar might go up, the dollar might go down. There are various possibilities. If you don't import and export very much, clearly the exchange rate won't have as much impact. It'll affect you a bit, but probably not as much. True? However, those are factors that aren't under your control. You know, that's the state of the economy. They're economic factors. Inflation next year will affect all companies here. Some companies it will affect a lot, some companies a little. But all companies will be affected by the rate of inflation next year, the exchange rate next year, and so on. True? But when you were doing all your projections, other factors have come in as well. You know, maybe Vita's company has just appointed a new managing director. He's new, and so he may turn out to be brilliant, he may turn out to be a waste of time. But surely that adds an extra element of risk. Next year he might be good and profits are high. He might be bad, profits are below. I think you see the point I'm making. Maybe Ines' company has had real problems this year with workers going on strike. Strike? Oh, it doesn't seem to happen here, but anyway, strike. Well, of course, her profits next year, they'll be potentially hugely affected by whether next year they carry on striking or next year the problem's solved. But their problems specific to her company. Managing director is specific to her company. The ones I mentioned before, like the rate of inflation, they're going to affect all companies. All right? Well, we say there are two types of risk. Those two I've mentioned. And this is only for written bits, but learn it. Again, I think, oh dear, I want to save you time. It is mentioned on page 109, so it's up to you whether you write this. But those two different things that make your company risky. I said one thing are factors specific to your company, like Vita's had a new managing director, Ines' people keep going on strike. We call that unsystematic or company specific risk. So unsystematic or company-specific risk is risk due to factors in the individual company, such as, and they're very textbook examples, but be able to give one or two. The two I gave were fine. A new managing director. Strikes by the workers. Well, that sort of thing, you do all agree that that makes Vita's company more risky next year in these projections, maybe high profit, low profit, similarly Ines, yeah? But these are factors specific to each company. Every company is different. If you are copying me down, leave a couple of lines space for something I want to fill in after. But the other type of risk we call systematic or market risk. And systematic risk are those other factors I mentioned earlier, that your profits next year clearly are at risk due to general economic factors. And again, the sort of thing we're talking about is the rate of inflation. Again, you've no idea what it is. Depending on the rate of inflation, your profits may be higher, may be lower. Again, if you were doing these projections on a spreadsheet, you'll have a whole range of profits. You know, the higher or lower, it does make it risky. All right? And very importantly, this risk affects all companies. Every company will be affected by the rate of inflation. You've got to agree with me. But critically important is this. Although every company here will be affected by the rate of inflation next year, every company will be affected by exchange rates next year. The level of risk will be different depending on the type of business. I said before, if you import-export a lot, changes in exchange rates will have a big effect on you. If you don't import-export very much at all, I'm sure you'll still be affected, but to a much lower degree. And so although all companies have what we call systematic risk, the level is different for different types of business. Now again, I'm nearly there, but are we clear? An oil company might have a very high level of this risk. A firm of accountants might have a very low level of this risk. We've all got it. We're all affected by the economic climate. But the level of risk depends on the type of business. Okay? Unsystematic, as I said. Every business is different. Completely different. Well, every business is different. Yeah. You all have your own individual problems that are nothing directly to do with the state of the economy. Okay?